Dear First Caribbean Securities Block Leaders, today, Saturday, June 19, 2010, we herewith want to introduce our video blog services to you. The purpose of this video blog services is to extend and enhance our communication and services to you in a more personal and warm way. First of all, let me introduce myself. My name is Eric Panneflek. I am the chairman of First Caribbean Securities and related companies. Besides that, I am also a lecturer at several universities in the subject of macroeconomics, international trade, and investing. The objective of our companies, together with our strategic partner, is to provide the best solution for our clients in the field of wealth management and asset protection. Our main topic for today is the turbulence that happened during the last 6 weeks, mainly caused by the sovereign debt crisis, the noise on the Korean Peninsula, and the energy market mainly dominated by the BP oil spill in the Gulf. Let's start with the European sovereign debt crisis. The sovereign debt crisis of Greece and Spain mainly dominated headlines during the last 6 weeks. As you can see from this chart, the total debt of Greece is estimated to exceed 125% of GDP in 2010, and that only 5 of the Eurozone countries are within the 60% limit as established by the European Community at the Maastricht Treaty of 1992. When we look a little bit further, we'll see that none of the Eurozone countries are within the limit, the preset limit of 3% of budget deficit as set by the Maastricht Treaty, which was the basic of the euro creation in 1992. Due to this, chances are that the euro will decline even further in the short term, and that this might lead to a euro crisis in the long term. In order to solve this problem, chances are that European politicians, instead of tackling the problem at its fundamental by coming with austerity measures, will choose for the more populistic way of increasing the money supply. Increasing the money supply will lead to a dilution of the European debt, but this will also lead to the dilution of all cash of European citizens and euro holders. When we watch back in 2008, this was the same strategy used by the United States Fed to tackle the financial crisis of 2008. Record shows that up to now, the USA Fed has printed out of thin air approximately $2 trillion in order to safeguard the United States of going into another Great Depression. When more printed money are chasing the same amount of goods, the prices of these goods will go up. History has shown that when bad money comes into the system, the good money will go into hiding in precious metal. Why? Because the value given to that new printed money is being deducted from the value of the already existing money. So the smart money, before being diluted, will hide into precious metal, gold, silver, platinum, and palladium. When we look back to the beginning of this decade, we will see that gold prices on an average has appreciated with approximately 30% per year. So here and there you hear that this is just a gold bubble. When we compare the amount of increase of the money supply during the last decade, we'll notice that the money supply during the last decade also has increased with approximately 30%, which means that if we continue to print money out of thin air to solve our debt problem, the good money will go into hiding into gold, and gold prices have the potential to increase even further when more and more money are being printed in order to try to safeguard the global economy to go into another recession. Next to the headline about the European sovereign debt crisis and the euro crisis was also the BP oil spill in the Gulf of Mexico and closing of the European air traffic due to volcanic ashes mainly from the Icelandic volcanoes. When we watch this chart, we'll see that approximately 70% of all oil consumed on our planet is being consumed in the transportation sector, and that approximately 10% of this is being used for air transportation. By closing of major European airports between late April and mid-May due to ashes from Icelandic volcanoes, we reduce considerably the demand for fuel during that period, with the consequence of temporary lower oil prices in May. The events regarding the BP oil spill in the Gulf still are not resolved, have led to higher restrictions for offshore drilling and a 6-month moratorium placed by the United States government for drilling anywhere around USA waters. These events will lead to higher lifting cost of oil. With the supply and demand picture in constraint and the start of the cooling and driving season on May 28th, higher oil prices are on the horizons. When taken into consideration that also on June 1st, we have started the 2010 hurricane season on the northern hemisphere, this in a La Nina atmospheric phenomenon period, we might see more intensive hurricane during this period that might affect operations of oil wells and operations during this summer. Taking all these events into consideration, chances are that $100 per barrel of oil is much closer on the horizon than most of us can imagine. Last but not least, it was a real pleasure informing you during this inaugurational video blog. And when investing, please consider your risk tolerance and age profile. Until next time.